This is the Asia Trade. I'm Paul Allen in Sydney, where the markets just opened.
I'm Haidi Stroud-Watts here at the Citi Australia and New Zealand Investment Conference. The top stories this hour. Asian stocks are set to follow a US sell-off as worries about the outlook for chips hits the industry that's been powering the bull run. But Wall Street banks notching a surprise trading haul from volatile markets. Donald Trump tells Bloomberg that tariff is his favourite word, defending his economic agenda 3 weeks out from Election Day. And central bank decisions are on the way from Indonesia, Thailand and the Philippines. Plus, coming up next, we're speaking live with the RBA Assistant Governor, Sarah Hunter.
Right, we've got some breaking news right out of the gate. It is unemployment numbers from South Korea for the month of September, coming in a little bit better than expected. The jobless rate, 2.5%. The expectation was for 2.6%, although that is a rise from what we saw back in August. The 2.4% we got there, though, was a record low. Still unemployment much stronger than the long-term average that Bloomberg Intelligence considers to be neutral for creation, for inflation, I beg your pardon. Job creation's been primarily coming from services there where wages tend to be lower, so not a lot of impact on inflation either. So that unemployment rate in South Korea, better than expected, 2.5%, adjusted the expectation, 2.6%. Let's take a look at how we're doing on markets at the moment. Just opened, of course, for trade in most of the major markets around the region. Here in Australia, kind of flat right now. We're off just a handful of points at the moment. A couple of stocks we'll be watching. Rio Tinto was out with production numbers a short time ago. They met estimates despite the slowdown in China. Rio warning that it's cautious on cost inflation as well. The oil and gas producer Woodside going to be in focus also. Record third quarter production there. Also Woodside announcing plans to delist in London. But taking a look at Nikkei futures, they're poised for a little bit of movement for the upside. And we've got a very weak yuan at the moment. Also a very weak yen, 149.26. Let's take a look also at US futures. We did, of course, see US stocks down, led by big tech. Couple of things going on here. Concerns over tighter restrictions on chip sales. It was also not a great set of numbers from the Dutch chipmaker ASML, only booking half the orders that analysts were expecting. That was down 16% in Europe, the most in 26 years. However, we do have futures pointing a little bit to the upside. Crude prices hovering around $71. Well, Garfield Reynolds, of course, leads our Markets Live Asia coverage, joins us now with a little bit more. Garf, we did see a bit of a pullback for US markets today, but considering Fed easing, the path of least resistance, I guess, still higher from here.
Yeah, Paul, very much so. As long as, I mean, the earnings season is going pretty well. Banks surprising to the upside, that provides some solid grounds for optimism. And the things that have gone on have kind of been bad have kind of been at the margins. The ASML was a shock to everybody. Not that that's a US company, but it's in the same business as Nvidia to some extent. But that's more about some specifics to do with ASML and its biggest customer, Intel. Not so much to do with what the Nvidia CEO is talking about, insane demand for its Blackwell chips. So all of that's kind of still in place. You're going to get some pullbacks. There wasn't anything that came out overnight that would argue against the market thesis that a soft landing is likely. Now, we know the Fed itself said sticking a soft landing is a really tough job to pull off. But it's certainly at least still in play, and as long as that's in play, equities are going to march higher.
There's a lot for investors to be contending with, as has been the theme over the past few months, right? There's central bank decisions, there's questions over the Fed, there's also, we're 3 weeks out from the US election, right? And of course, the issue of what this means for trade has been revived too. Do you think investors are paying attention to that?
They're definitely paying attention. When you look at some of the action overnight in both the Chinese yuan and the Mexican peso, both of them weakened as former President Donald Trump doubled down on tariffs, his favorite word, and as he himself put it, and they showed some weakness as he was speaking overnight. The interesting thing is the way that weakness, you know, wasn't a major move. The moves were fairly contained. The takeaway from that isn't that investors haven't been paying attention. It's that they have. They've already priced in a lot of the potential downsides on that front, at least initially from a Trump presidency. You know, we also saw in general some emerging market FX weakness. Certainly, Asian assets will, you know, they'll be a lot more nervous in many ways going into the election than even US assets will, because, you know, while in the US a lot of investors don't see a huge difference, you know, there are pluses and minuses for each of the candidates. They're also quite focused on, you know, whether either party sweeps. For assets in Asia, the question of whether or not we get more Trump tariffs, that's the major one.
Garfield Reynolds, who leads our Markets Live Asia coverage there from Sydney. Well, of course, with the revival of all this tariff talk, Republican presidential nominee Donald Trump has told Bloomberg that he loves that word, the word tariff, as he denied his protectionist policies could fuel inflation and spike the national debt. Trump spoke with our editor-in-chief, John Micklethwaite, about his economic agenda, now just 3 weeks out from his election showdown with Democratic nominee Kamala Harris.
Because we're about growth. She's got no growth whatsoever, and we're all about growth. We're going to bring companies back to our country. You look at even today, as I was driving over, I see these empty, old, beautiful, like steel mills and factories that are empty and falling down. Some have been converted to senior citizens' homes, but that's not going to do the trick. And we're going to bring the companies back. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs, because I'm a believer in tariffs. I'm not sure that you are. I don't think you are, but I congratulate you on your career. But to me, the most beautiful word in the dictionary is tariff, and it's my favorite word. It needs a public relations firm to help it, but to me, it's the most beautiful word in the dictionary.
Tariffs, do you think that will bring in the revenues? To use another bipartisan group, Peterson Institute, they say they only bring in $200 billion. That is that's barely the cost of 2 of your promises.
Yeah, but that's like, for what company are you talking about, okay? Look, I've brought in with tariffs, and I was just getting started. Then COVID came, and we had because I tell you what, I did a very good job in COVID. Nobody knew what the hell it was. I call it the China virus because I like being a little more accurate. But when that came, but we got hundreds of billions of dollars just from China alone, and I hadn't even started yet. But tariffs are two things, if you look at it. Number one is for protection of the companies that we have here and the new companies that will move in, because we're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before, and we're going to protect them when they come in, because we're not going to have somebody undercut them.
That's Donald Trump there speaking with Bloomberg's John Micklethwaite at the Economic Club of Chicago. And staying with former President Trump, Bloomberg has learned that the EU is preparing a list of US goods it may target with tariffs if Donald Trump wins the election and follows through on his threats to hit the bloc with new trade measures. Sources say the levies are not a base case and would only be used to retaliate. We're told the EU would prefer to seek agreement with Trump on areas of common interest, such as China. Coming up on the Asia Trade, RBA Assistant Governor Sarah Hunter joins us in a moment with the central bank's latest views on inflation and interest rates. And we get a progress report on Asia's energy transition with GenZero CEO. Plus, HSBC Global Private Wealth tells us why they're staying neutral on Chinese stocks. That's despite Beijing's stimulus plans. Much more ahead. This is Bloomberg.
take a look at how we're setting up this morning here in Australia. We are expected to see some gains really proceed when it comes to financials, being the leaders here when it comes to the ASX. Some of the strong bank names in the US will give that leadership with really a hugely volatile quarter, but still we saw the profiting from Wall Street financials overnight. That's likely to carry through to the Aussie session as we get underway. We are seeing a little bit of downside there when it comes to trading in the Aussie dollar. We had the US dollar, I should say, rising, and bonds are really tracking treasuries higher as well. Well, Australia's central bank says it's keeping watch on inflation expectations in the current period of really elevated and sticky prices. Sarah Hunter is the Assistant Governor at the Reserve Bank of Australia and joins me now. Sarah, so great to have you with us, Assistant Governor, I should say. It's really a pleasure, and we appreciate your time. How vigilant are you feeling when it comes to inflation pressures? We're just about a couple of weeks out from the third quarter numbers. Are you feeling comfortable?
It's a good question. We're clearly watching the data very, very closely. We're very conscious in terms of actual inflation outcomes that, headline wobbles aside, we've seen some persistence in our underlying inflation metric over the last year or so. So we're really watching to see if that continues to disinflate a slower pace of inflation. And then we'll be evaluating that and looking at that as we go into the November board meeting. And that's also when we'll publish our next set of forecasts.
One of the biggest changes has been the tax cuts and the energy rebates. Do we have an indication yet as to what households are doing with that?
Yeah, it's a good question. That's a key risk that we're monitoring. We flagged it back in our August SOMP, and we're certainly going to be looking at it very carefully over the next little while. We've got some information. We've had some of the retail sales data for July and August has come through, and we've also we make use of some of the card spending data that now gets published. That's very useful, and also look at what they tell us about what's flowing through people's bank accounts. Just based on that, it's not any data that we have. We can see that the tax cuts have come through as expected. People have got more flowing into their bank accounts, but the spending position we're still waiting to get a real read on, and of course we won't get the official sort of data until we get the national accounts at the start of December. So we're monitoring it very closely, looking at all of those high frequency indicators, but we've got to wait, as everyone has, a little bit longer until we get the official data.
What about the implications of too much fiscal spending? Certainly the likes of the IMF have expressed their concern over what local and federal governments are doing. Is that something that you're being very watchful of? And at what point does the RBA kind of need to talk about that?
Well, so we consider government spending as it's obviously one part of total spending through the economy, and it's an important part. So we take those government spending decisions, budget decisions as given. So we did a sort of fairly big update after the May S&P and going into August, because that's when we got the federal budget and a number of the state budgets as well. We take those as given, we feed them in, but for us really it's the aggregate picture, what's happening across the economy that really matters. So we're considering what's happening in the public sector, but also what's happening across the private sector. That's not just households, although they are a very important part, biggest part of demand, also businesses, what's happening with residential construction and with trade. So we're taking the whole picture together and looking at what that means for the labour market and for inflationary pressures. So it's how the whole thing comes together is really the focus for us.
Does the China stimulus story, the potential rebound path, change that aggregate at all? Like, what do you factor in with your calculus there?
Yeah, absolutely. And it's obviously very recent news. It's certainly news that we've had since August, so we are factoring it into our forecast going into November, and we do pay, as you might expect, a lot of attention to China, given how important it is to the economy here. So we'll be looking at that and what we think that might mean in terms of growth, not just for this year, because obviously most of this year is now done, but really what it means for 2025. So we're working that through at the moment, but it's still very new news for everybody, so we haven't got our definitive forecast locked in just yet.
Do you think during the period of China weakness, the Australian economy has in a way sort of, necessarily not decoupled, but certainly diversified from that reliance? Or is this still a pretty big chunk of what happens?
It's an interesting question, because it really, there's two parts to it. There's what happens to demand in China, obviously that's determined over there, but also how producers here respond, businesses here respond, so particularly in the mining sector, but also what we might see in terms of tourism flows, international student flows and that sort of thing. We have seen that there has been strong growth in other markets. So that's not necessarily a China story. That's more what's happening there. And that's come through particularly on the student side and a little bit on the tourism side as well. But having said all of that, China is still by far and away Australia's largest export partner. We still have very strong linkages there. And China matters obviously for the global economy more broadly, and that matters for global economic conditions. And as a small open economy, that generally matters for us. So China's still very important, and we still put a lot of our time and attention into thinking through what's happening there and what it means for the economy here.
Cost of living pressures are still obviously top of mind. It was interesting speaking to the Citi Australia CEO yesterday, and he was saying even having rates just on hold and this idea that, at least we'll stay here has done enormous things when it comes to corporate sentiment. Do you think that's enough to boost household sentiment? How much do you worry about what households and consumers are feeling right now?
Well, we're certainly looking at households very, very closely. They're clearly the largest part of the economy in terms of demand, and there's definitely uncertainty about how households are going to respond to everything that's sort of happening at the moment. The cost of living pressures have obviously been dragging for quite some time. We're very aware of how tough it is for people right across the spectrum, not just the mortgage holders, but if you've got paying rent, then that's a real squeeze there, and other price pressures as well. So we're very conscious of that squeeze. It's been there for an extended period of time. Now we're trying to, as we spoke earlier, work our way through what the tax cuts, energy rebates and other things might mean for household spending. And consumer sentiment is one of the things that we're tracking, and the latest data, it has lifted a bit. But we'll have to just wait and see how that plays through for actual spending numbers. It is a key source of uncertainty, though, and it's something we're certainly focused on at the moment.
The housing market, obviously not a key remit when it comes to the RBA, but you must be feeling a bit discouraged to see prices still continuing to rise in this environment. How much does that sort of complicate the scenario?
It's certainly an interesting outcome and somewhat unexpected from economists in general. The way we're looking at it and the way we really think about it is through two channels. One, what it means in terms of dwelling investment, so residential construction. And we know that there's a number of challenges in that sector around construction costs, around availability of labour, getting projects off the ground. And so supply there has grown pretty slowly over the last few years. In fact, it's been declining most recently. Equally, the other channel that we look at very closely is the wealth effect for households, and for higher house prices is a little bit of a boost if you own your own home, if you're in that position. We think about how that might feed through into consumer spending, although we do know there's many other factors for consumer spending, as we just talked about, and that generally consumer spending has been very weak in the last period. So we're monitoring it more for what it means in terms of the macroeconomy, and then we also obviously have a lens to what it means around financial stability. So there's a number of different channels for housing. We do spend quite a lot of time on the housing sector. It's been interesting to see how it's played out through the last couple of years. It's clearly got further to go in terms of both the supply and how that starts to come through, but also thinking about what might happen to prices going forward.
We were just watching our interview with the former President Trump, and he's talking about how tariff remains one of his favourite words, and I do wonder, what do you assign in terms of the level of risk for Australia? Should we get another Trump presidency, both directly with trade and as a proxy of China?
Well, we leave politics to the politicians, and clearly this is overseas as well. But in the context of any sort of political potential change in government or continuation of government, but change in policy, we're thinking really about what the actual policy is and what gets enacted and how that might flow through. So if we did see some change to the tariff settings in any country, we'd be thinking about that in the context of how that impacts those economies directly, and then how that might flow through the global economy. This particular example is no exception, but we'll wait and see what happens, and then we'll make our views after that.
Sarah, really great to have you with us. Sarah Hunter, who's the Assistant Governor at the Reserve Bank of Australia. And Paul, many more conversations to come here from the Citi Australia and New Zealand conference.
All right, thanks, Heidi. Let's take a look at what's moving on Australian markets at the moment. A couple of stocks to watch. One of them, Rio Tinto, particularly exposed to China, noted in its third quarter production report the uneven economic recovery there. Production numbers pretty good for Rio Tinto, but that stock off about 1.5% right now. Also heard from a couple of the big energy giants here today. Origin having its annual general meeting, reaffirming its full-year forecast, although the stock there down about 1.3%. Woodside Petroleum, meanwhile, gaining 1.2%. Woodside announcing record third quarter production, but narrowing its production forecast for the full year. We have plenty more to come on the Asia trade. This is Bloomberg.
while we are not yet where we want to be, the impact of the changes we're making is clearly evident in our momentum and our improving performance. Turning to the macro, while growth is a lot slower than last year, global economic performance continues to be surprisingly resilient. Whatever you want to call the U.S. landing, the sentiment around it is more optimistic.
That's Citigroup CEO Jane Fraser speaking on the firm's third quarter earnings call. And Citigroup was among some of the big US banks that reported on Tuesday alongside Goldman Sachs and Bank of America. All three lenders posted equities and fixed income trading hauls that surpassed estimates for the quarter. Let's take a look at how they did there. A little bit of softness there for Goldman, but Bank of America better by 0.5%. Citigroup reversing away despite that beat. But for more on this, let's get to Bloomberg Intelligence's Global Investment Bank Senior Analyst Alison Williams. So, Alison, it was a very volatile quarter, and I guess volatility means pretty good profits.
So it's the volatility and also the asset prices. The world's market capitalization, at least for stocks, reached a record high exiting the quarter. And so, the strength in equities really showed up in equities trading. We heard from the banks strength in derivatives, strength in cash, strength in prime, and of note, a strong end to the quarter, especially in Asia. So the U.S. environment helpful throughout the quarter, but Asia especially at quarter end. So we saw in the equities trading, fixed income trading about in line, but still a little bit better, and fees also doing better on the investment banking side.
A lot of bright spots there when it comes to deals and the volumes that we're seeing and returns. But are there concerns on the regulatory front? What were some of the risks that were highlighted by these various earnings announcements?
Sure, and I think it perhaps not directly in the earnings, but for Citigroup in particular, which is working through some regulatory issues, I think that there are some jitters around the potential for a risk related to an asset cap. So Wells Fargo was the first bank to receive such a measure. It was unprecedented. And then late last week at TD was sort of the second bank that this has happened to. Now, granted, that was only for their U.S. subsidiaries. This morning, there was an article citing some internal analysis at Citi, which, again, we didn't necessarily think there was anything surprising in the article. It talked about, potentially some of the shortcomings with regard to compliance and training and the like. I don't think that's surprising, but I think there is a general feeling that regulators are getting frustrated with lack of progress. There's other signs that Elliot Stein, who's our litigation analyst, and Nathan Dean, who's our regulatory analyst, have sort of pointed to. So I think that's why you saw Citi really trading down today.
Bloomberg Intelligence Senior Analyst Alison Williams there with those US bank earnings, and that's likely to trickle through when it comes to outperformance in financials today in Asia. But take a look at how we're tracking when it comes to Kiwi assets at the moment. We are seeing a bit of downside there. That inflation number, the lowest rate since early 2021, really reigniting expectations of further RBNZ cuts.
And continued progress towards our goals is not guaranteed. So we must stay vigilant and intentional. What does that look like? Well, it means continually assessing the economy and balancing both of our mandated objectives. And we have to be really focused on fully delivering on 2% inflation while ensuring that the labor market remains in line with full employment.
Let's take a look at what we're watching, and that was, of course, was the San Francisco Fed President Mary Daly there on the U.S. economic risk outlook. But take a look at how we're setting up and going into this trading day. We are seeing the Kiwi dollar on the back foot after inflation slowing to the lowest rate since early 2021, back inside that 1% to 3% target band for the RBNZ. We saw that decline there when it comes to Kiwi greenback as well as Kiwi trading against the Aussie dollar. Dollar yen is holding fairly steady at just over that 149 level, and dollar China, we are seeing a further weakness when it comes to the yuan, and certainly some of this sort of lack of conviction over where we go next with this stimulus package. We are looking ahead to a Thursday briefing now when it comes to the housing minister meeting with the central bank. Let's get now more from our interview with the Republican presidential nominee, Donald Trump, just 3 weeks before the US heads to the polls. He told our editor-in-chief, John Micklethwaite, why he thinks the tariffs on Chinese steel imposed, of course, in his first term, have proved to be effective.
If you want the companies to come in, the tariff has to be a lot higher than 10%, because 10% is not enough. Guys, they're not going to do it for 10. But you make a 50% tariff, they're going to come in. Let me tell you the other thing about tariffs that's great. Our steel companies, as you know, 3-4 years ago, they were all when I was in office, I saw a man from a big steel company, and he was devastated. I knew him for a long time. And it's been a tough business. It was a great business many years ago, and I would not let U.S. steel be sold to Japanese, by the way. Psychologically, I think it would be
That's the Nippon steel, as you know.
Yeah, I wouldn't let it be sold. But I would stop it if it hasn't been completed by the time I'm president, because I think it sets a horrible tone. But I had a lot to do with steel. We were going to lose all our steel companies because China, as you remember, was dumping steel at levels that nobody's ever seen before. And I put a 50% tax on that and a tariff on that, all dumped steel. And it was also bad steel. It was what they call dirty steel. It wasn't good steel, which is a bad thing for structural components of buildings and planes and things like that. They were dumping crap into our country. And I put a 50% tariff. I started at 25. I raised it to 50 because the 25 didn't quite do it. I raised it to 50, and that did it. They stopped dumping steel. And I saved our steel mills by having that. We saved it. We saved our steel. Now, what was left, because we've lost so much, but there are certain companies you have to have. There are certain things you have to have. Steel, you have to have. If you go to war, you know, there's a possibility you go to war. I kept us out of war. I was the only president in 82 years that kept you out of a war, except I defeated ISIS, but I inherited that war.
It's Donald Trump there speaking with Bloomberg's editor-in-chief, John Micklethwaite. And there's more on the election race in today's Bloomberg Big Take, which looks at how dozens of lawsuits are playing into the campaign. Subscribers can read that story in full on the terminal and on our website, bloomberg.com. Let's take a look at some of those big tech names in the US, because they certainly weighed on sentiment today. Let's start with Apple. The exception to that rule, Apple shares actually hit a record on optimism around AI. We've been hearing a lot about how AI is going to play into the iPhone 16. Well, on Tuesday, Apple also announced a new iPad mini, which will have similar features, so the market liking that news. Apart from that, it was not a day to remember for big tech. We did have NVIDIA weaker by almost 5%. This is on the news that the Biden administration is discussing capping sales of advanced AI chips from NVIDIA on a country-specific basis. Yeah, you can fill in the blanks there. It wasn't a great day for ASML either. That's Europe's biggest chip maker, the Dutch company, booking only half the orders that analysts were expecting. ASML really suffering, down 16% in regular trade. That was the most in 26 years. Take a look at Qualcomm as well. After hours, Qualcomm saying that it's likely to wait until after the US presidential election in November before deciding what to do about its offer to buy Intel Corp. So let's get a little bit more on Qualcomm and what sources are telling us about that possible move on Intel. The tech reporter Annabelle Jewellers joins us now. So Annabelle, a bit more clarity on what happens after November. What's the story here?
Yeah, I mean, it's sort of unsurprising in a way. There's a lot of chip companies out there that are really just waiting on the outcome of that vote. But for a company like Qualcomm, sources are telling us that they're thinking about two things in particular. First, you've got the antitrust landscape, and second, it's how America's relationship changes with China as well. what we're hearing, as you said, Qualcomm wants to wait until actually after the inauguration in January to decide on the direction that they take with Intel. If you recall, this possible M&A we reported on back in September, at that time, we were also hearing that Qualcomm had approached antitrust regulators or officials in China, gauging their response or trying to gauge their response. And we're hearing, again, that they didn't get any sort of reaction from Beijing because they're waiting to see if that bid is made official. But certainly, as we said, a possible takeover, one that's going to be watched very closely, given it would be one of the biggest M&A deals we've ever seen.
Would there be any other advantages as well for Qualcomm to wait until after the election?
Well, I think the really obvious one is around earnings, because if you also recall the earnings we had for the second quarter, they were pretty bleak, and we saw a huge share price reaction off the back. We saw more job layoffs coming through. We saw questions around the outlook for different parts of the business, for instance, the fab part of it. And so again, if you wait and see those third quarter numbers where analysts are seeing perhaps a $1 billion loss, it of course makes that deal a lot cheaper for Qualcomm. So it would make sense perhaps for them, again, to delay that. Qualcomm's deliberations, though, we do know that they're ongoing, or that's what we're hearing from sources. Of course, the certainty or that lack of certainty is still there, whether they would actually ever pursue this deal with Intel, and we haven't actually had any sort of response really either from Qualcomm or Intel.
Well, I mentioned a minute ago those terrible numbers for ASML, but we keep hearing about the overwhelming demand for chips. What went wrong here? Where's the disconnect?
Yeah, I guess it's sort of that sort of two-speed recovery that we see in the chip space. Some, particularly AI chips, are doing really well. Others that are more legacy ones that are used for things like consumer electronics, automotives, they're still kind of getting out of that slump. But ASML, we know it's a Dutch company. It makes the world's most advanced chip-making machines. And as you said, it had those third quarter figures coming out, and they were not great. We saw around half of the expected bookings coming through. So we saw, for instance, $2.8 billion in the third quarter. That's US dollars. The average analyst estimate had been for $5.9 billion. So that is a significant loss there. And as you said, that share price reaction, I mean, off 16% in Amsterdam, that's the biggest loss we've seen going back to 1998. So you're talking about 26 years here.
All right, Annabelle Jewellers there. And we do have plenty more on chips in tomorrow's show. We're going to be speaking exclusively with AMD's Chief Technology Officer, that's Mark Papermaster, about their new AI products and also about the outlook for the sector in Asia. Here's some other corporate stories that we're tracking. Data center developer DataBank has raised $2 billion to build 3 facilities across the US, and the latest sign of superheated investor interest in AI. Pension fund Australian Super led the raise with $1.5 billion. It'll become a minority owner of DataBank and appoint a director to the company's board. US-listed shares of LVMH slumping after the luxury goods giant missed estimates in its latest results. Sales fell for the first time since the COVID-19 pandemic, hampered by slumping Chinese demand. Morgan Stanley says declines in third quarter organic sales for the LVMH fashion and leather goods unit came in well below expectations. Boeing shares advancing after the plane maker took a step towards raising up to $25 billion in bond or share sales to help withstand a prolonged strike. It's also secured a $10 billion credit agreement with US banks, and this added firepower could help Boeing improve its bargaining position with striking workers who are seeking higher wages and a reinstatement of pensions. Shein is said to be adding more banks to help arrange its potential listing in London. Sources say Barclays and UBS have been picked as bookrunners for the online fashion retailer's IPO. We're told the listing could happen as soon as early next year, valuing the company at about $65 billion. Up next, we get a progress report on Asia's energy transition with the CEO of Singapore's GenZero, Frederick Teo. This is Bloomberg.
AI can be part of the solution and is a problem at the same time. So if I start with the problem, AI, data centers, they consume a lot of energy and they need a lot of water. So actually we're providing services to the companies which are doing AI, and it's a growing market. On the other side, AI can benefit ecological transformation and saving water, saving energy, saving CO2 and so on and so forth. And can make a company like Veolia more efficient.
It's Estelle Braclianoff, CEO of the world's largest environmental services company, Veolia, talking about the pros and cons of AI. Now, GenZero is an investment platform founded by Singapore state fund Temasek that focuses on investments aimed at accelerating decarbonisation. Frederick Teo is the CEO. He joins us now from Singapore. Frederick, thanks so much for joining us today. And it's 2 years, I believe, since GenZero was launched. I'm just wondering if you can give us a bit of an update on the state of play, how much you've deployed so far, and where are you seeing the fastest progress in terms of decarbonisation technology?
Sure, thanks, Paul. Thanks for having me. GenZero, as you say, was set up about 2 years ago. We have made steady progress in our investments across our 3 investment focus areas, namely into nature solutions, technology solutions, and carbon market solutions. I think on nature, we see a lot of interest in moving into sustainable forestry and sustainable agriculture types of areas, which will help us to minimize the carbon emissions from agriculture and forestry, which is an important thing. In technology, we are continuing to focus on hard-to-abate sectors like sustainable aviation, as well as carbon capture. And then in the case of carbon ecosystem enablers or carbon market solutions, we continue to believe in the importance of investing into creating a high-integrity, transparent, effective carbon markets to assist companies and countries to move along on their decarbonization journey.
Yes, so obviously some companies, some countries are lagging behind in this journey, as you call it. Where are the challenges the greatest? Where is there more to do?
Well, energy transition is actually one of the most important issues when it comes to helping countries move along on their decarbonization and net zero journey. If you take Asia Pacific, for example, there are about 3 or 4 major challenges that we face. Firstly, we are a very diverse region. There are countries that are advanced economies, but there are also countries that are struggling from their economic development. So therefore, their capacity to be able to pay for this transition and to move along on this decarbonization journey is very different. Secondly, we are also geographically very, very diverse. We have large countries like where you're from in Australia, which is a continent unto itself and then blessed with renewable energy potential. But you also have very, very small city-states like Singapore, where the land area would be insufficient for us to even, if we were to put solar panels across the entire country, to meet our energy needs. Thirdly, we don't have a common approach towards carbon pricing or to price carbon or to reduce emissions in terms of target setting and policies. So in Singapore, we have a carbon tax, we have a reasonably high carbon price, but then there are many countries that haven't even started thinking about putting a carbon framework in place. And lastly, the Asia Pacific has been blessed with a very high pace of economic development and growth in the past 2 or 3 decades. That basically means that we are the region that has also expanded our sources of energy most significantly during this period of time. And that means that much of our power plants, especially those that are coal-fired, are very, very young. So the average age of coal-fired power plants in our region is like less than 15 years. So to be able to shift some of these things towards a much more net zero, clean energy, clean transition pathway is particularly challenging.
Frederick, you speak about the challenges, and I think it's been quite discouraging for a lot of people to see the sort of emphasis really shift away from the energy transition and, you know, a lot of investment still being made in traditional and fossil fuel energies. With that in context, what are you expecting from COP29 in terms of the biggest wins that might be able to be secured?
I think there are 2 or 3 aspects to this. I think firstly, we need to bed down and facilitate cross-border collaboration on this particular journey. Like I mentioned, in Asia, right, there are countries that have and countries that don't when it comes to renewable energy potential. If we are not able to facilitate the cooperation between these countries, then the countries that are perhaps disadvantaged from a renewable energy point of view will find it extremely difficult to get onto this net zero journey. Now, there are practical steps that we can take. For example, infrastructure investments into facilitating these cross-border collaboration, like for example in ASEAN, we are talking about a power grid that can interconnect all the different countries so that we are able to trade green electrons with each other. Another area in COP that I hope that we will make progress on is about Article 6. Now, Article 6 provides a framework for countries to actually trade ITMOs or carbon credits in a way that can be useful for their carbon accounting when they are reporting for their nationally determined contributions. That will be an important milestone or progress to allow countries to collaborate with each other, and I think that that will be key.
We've seen some interesting sort of trends when it comes to private versus public markets, and some of the data that Bloomberg New Energy Finance has combed has really shown that public markets are much more susceptible, if you will, when it comes to fossil fuel holdings. How key are private markets to you in this environment in terms of being able to make that further progress that we've been talking about?
I think we do need to have a consensus within the finance industry, within capital markets, on understanding what is the proper role for transition and how we actually need to move out of fossil. I think increasingly over the past 5 to 10 years, there is that consensus emerging that we do need to transition out of fossil. The question may be a difference around how fast we do it and exactly how we do it. But I think that directionally, I think that there is very little debate now on the fact that we need to move into a lower carbon economy. So therefore, what we need to create really are the correct economic incentives, whether it is through policy or some of the government support in terms of lowering the cost of capital, and improve the economic incentives for the capital markets to allocate a lot more capital towards low carbon solutions rather than continue to bet down on fossil fuels. Obviously, this is going to be complicated by near-term considerations around energy security, access, and cost. But I think that if we are able to put our minds to it, we would be able to execute this transition.
When it comes to looking ahead to 2025 and beyond, what technologies are front of mind for you in terms of what you're investing in, and how much are you looking to deploy?
Well, in terms of technologies, we continue to focus on areas that are particularly hard to abate. I think that focusing on decarbonizing aviation is going to be a priority for us as we invest into technology companies that make sustainable aviation fuel or equipment manufacturers that support the scale-out of SAF production. That will be actually quite important in lowering the prices for airlines and for consumers. But beyond technology, it is also important for us to think about investing into nature. Because in Southeast Asia, for example, we are home to some of the largest nature-based carbon sinks in the world. That will be critical in allowing us to meet our net zero commitments. And nature-based solutions, from a business point of view, allows us to have a much more cost-effective way of mitigating carbon emissions. They are also, from a near-term perspective, a lot more scalable. So I would say that just a singular focus on technology probably wouldn't be right. We need to think about investments both into nature and technology in order to achieve our net zero targets.
Frederick, really appreciate your time with us today. Frederick Teo, who's the CEO at GenZero. More ahead here on the Asia Trade. This is Bloomberg.
Just getting some breaking news out of Japan. It is core machine orders for the month of August, and quite a dramatic contraction here, which was unexpected. 1.9% contraction for the month of August. The survey was for a modest 0.1% expansion. On year, that translates to a 3.4% contraction to core machine orders. So, yeah, a big slowdown in that metric. We do have a very weak yen, by the way, still hovering around that 149 level. Stocks in Japan, meanwhile, in positive territory. But that core machine orders reading, yeah, a big downside surprise. Let's take a look at what's going on in the commodity space as well. We've seen a lot of softness for some key commodities in the London Metals Exchange. We saw copper prices come off. We saw nickel and zinc prices lower as well. If we take a look at iron ore, that's still holding reasonably firm above $100 per tonne. Not a lot of movement in the crude price. Of course, we did see a lot of movement in the crude price earlier this week, but seems to have found some stability around the $71 level. Well, Bloomberg has learned that China is considering allowing local authorities to issue as much as $853 billion in bonds through to 2027, mainly to refinance off-balance sheet debt. Let's bring in our China correspondent Min Min Lo in Hong Kong. So, Min Min, China talking about this debt swap to rescue local governments. What are the details of this, and is it going to do the job?
Yeah, so this is not official yet. This is what we're hearing from sources. And I know it's going to sound a little bit confusing because Chinese financial media Caixin yesterday reported that the government was mulling issuing 6 trillion yuan in ultra-long special sovereign bonds over 3 years to tackle local government debt. But what Bloomberg has heard is that it is not going to be these ultra-long special sovereign bonds, but rather special local government bonds. And this is critical because if it is local government instead of central government that is issuing these bonds, that means that there will be no transference of the debt burden from local governments to the central governments. Local governments will still have to service their debt, but perhaps they have a longer time frame to repay at a lower annual interest rate as well. Now, the estimate is that there are about 50 to 60 trillion yuan worth of these off-the-books hidden debt that are usually taken on by other companies such as local government financing vehicles. So what this debt swap does is that local governments will then take on these hidden debt onto their balance sheets, and hopefully that would also free up resources for them to actually spend more money to revive the economy and pay off all of those delayed payments that are owed to contractors and civil servants.
What are we expecting when it comes to this housing department briefing that we're expecting in conjunction with the central bank? Do we see more support measures? I mean, there's been so much property restriction easing lately.
Yeah, so the Housing Ministry is going to hold this joint briefing with unidentified officials from the Ministry of Finance, from the PBOC and the National Financial Regulatory Administration. Now, what we think we can expect from that briefing is perhaps more details around the implementation of measures to stop the decline in the housing sector, because the Ministry of Finance on Saturday had said that local governments can use funds from local government special bonds to buy back idle land as well as unsold home, but they failed to give us the scale of how much of these bonds can be issued as well as the target in terms of how much of these homes they want to clear out from the existing inventory. There's also no timeline as well, so hopefully we will get a little bit more details on these implementation. And also there has been no indication so far as to how the government will resolve the 48 million homes that are sold but not yet finished. This is a key barrier for home buyers to get back into the housing market as well.
Min Min Lo there.
This is the Asia trade. We're counting down to Asia's major market opens, and Haidi, could be an interesting day for tech stocks. We saw somewhat of a tech sell-off in the US there, and some very disappointing numbers from ASML. Also some really weak core machine orders out of Japan a moment ago. That's the lowest figure we've seen since May 2023.
Yeah, we are likely to see that impact when it comes to related sectors and stocks here in Asia, right? But Paul, we're also watching the potential political implications, not just on tech, but global trade and that relationship between the US and China as well. We heard in that conversation with the former President Trump how much he loves tariffs as his favorite word, and, you know, really kind of pushing back against any criticism of his economic agenda. We're just 3 weeks out from Election Day.
All right, but we do now have the market opens in Japan and South Korea. Let's take a look at how we're tracking in the early going. Some immediate declines there for the Nikkei, off by about 1.4%. We do, of course, have a very weak yen as well. We take a look at the topics also reversing away, down by about 1.2% at the moment. I'm just waiting for some of those other names to start trading in terms of the tech space in Japan. Take a look at the yield on the 10-year as well, 0.963 at the moment. Having a look at Korea, also some weakness for Korean stocks. The Kospi off by 1.1% at the moment, and the tech-heavy Kosdaq index, perhaps unsurprising, off by about 2/3 of 1%, just in terms of those numbers that we had out of the Dutch company ASML. Wasn't a great day for them. That stock was down about 16% in Europe. That was the most in 26 years after booking barely half the orders analysts expected, Haidi.
Yeah, take a look at what we're watching when it comes to this early stages of the first hour or so of trading when it comes to Australia and also over in New Zealand. It is a bit of downside there. In fact, Aussie stocks are taking a bit of a breather from that record high level that we've really seen over the past few sessions, and we are seeing even some of the leadership expected from the financials is not carrying through to that broader gains. Iron ore miners in particular are weighing. We had Rio Tinto shares dropping as well, demand from China remaining soft, and some of those concerns over the strength of the stimulus package's ability to sustain a recovery is still very much in play there. Watching Australian bonds as they really followed treasuries higher. We had quite a stark picture when it comes to the inflation print out of New Zealand there as well. So we're watching that as that inflation level in New Zealand slowing to the lowest since early 2021. That's caused some repricing when it comes to just how much is going to be expected from the RBNZ. We're also watching oil prices there as well. Middle East tensions, of course, continue to play in, as does the China focus there as well. We're seeing crude continuing to put on a bit of an advance in this session. But of course, at the core of it all is also watching what the Fed does next, right? We spoke or heard from the San Francisco Fed President Mary Daly saying that officials still need to stay vigilant despite how good the recent sort of string of data has been to protect that growth. Take a listen.
And continued progress towards our goals is not guaranteed. So we must stay vigilant and intentional. What does that look like? Well, it means continually assessing the economy and balancing both of our mandated objectives. And we have to be really focused on fully delivering on 2% inflation while ensuring that the labor market remains in line with full employment.
All right, let's get to our next guest. Fan Cheuk is Asia CIO at HSBC Global Private Banking and Wealth. Fan, thanks so much for joining us today. Just want to pick up off those remarks from Mary Daly there. I mean, it looks as if a soft landing is coming into view. Where do you see the odds of that happening, and what's the trajectory for the Fed in terms of rates from here?
Yeah, I think the latest high-frequency data reinforce the outlook of soft landing, including the strong labor market and consumer spending in the U.S. remains solid, and the disinflation trend continue to unfold. Although September CPI inflation numbers has come in slightly higher than expected, but overall the moderation of inflation is still expected. So we continue to expect the Fed will continue with the policy easing, and we anticipate 25 basis point rate cut at each of the next 6 policy meeting in the U.S. So this is reflecting a global synchronized policy easing cycle have already kick-started, and this will bode well for the return outlook of risk asset, in our opinion.
Yeah, we're seeing a little bit of softness in markets in the US and now in Asia, particularly those tech stocks. We've been talking about the story around that. But with the easing narrative really starting to gain momentum now, is the US still your preferred market here, and is the path of least resistance to the upside?
Yeah, although the U.S. equity market are now trading near all-time high, but we expect there would be further upside potential in the market, mainly driven by the broadening of earnings growth. As we have seen from the second quarter corporate earnings, in fact, the growth momentum outside of Magnificent Seven has been improving. So going into the third quarter, we're now starting to see more corporate earnings number reflecting this broadening trend is holding up. So this is going to provide the most important fundamental support for the U.S. equity market performance. Currently, market consensus project around 10% 2024 earnings growth and anticipate growth acceleration to reach 15%. EPS growth for 2025. So this reflects the expansion in corporate improvement, and this will bring new investment opportunities going beyond just big tech.
Do you see new opportunities now materializing in China, or are you still on the sort of wait-and-see side in terms of how much conviction there is over the stimulus measures and if the transmission effect is going to be effective?
Yeah, I think China's policy pivot since late September is definitely a positive step to provide more forceful policy support to sustain the recovery momentum. However, I think the more critical fiscal stimulus plan will still need to take some time before the market can get full clarity regarding the scale and the timeline for delivery of the stimulus package. After the recent NDRC and Ministry of Finance press conference, the market still need to wait for more details regarding the fiscal expansion plan. That could be a multi-year fiscal easing cycle, but currently market really needs to see more evidence that will show how the policy support can provide a new driver to improve the structural growth outlook of the Chinese economy. So in the near term, we expect market volatility to persist after the sharp rally in the recent 2 weeks. So we maintain our neutral tactical asset allocation to China equity market. And we do find tactical opportunities in selected sector that delivered enduring earnings growth.
Yeah, internet leaders, state-owned enterprises and resilient consumer stocks are among them.
Yeah, I think our favorite place to position in the China equity rally mainly focus on the high-quality stock. I would identify the Chinese internet leaders, especially for those who which are trading at substantial valuation discount to their U.S. Industry peers. And I also think that the quality SOE paying high dividends are going to attract yield-seeking investors, and given their very stable cash flow and solid underlying earnings, this will also bode well for the re-rating outlook. And then for the resilient consumer leaders, they are well positioned to benefit from the expected rollout of more consumption-boosting measures. Currently, we are still waiting for better clarity regarding details of those new stimulus that will drive faster recovery of consumption spending. But this has been highlighted at the last Politburo meeting and the latest policy statement. So we do expect the resilient consumption leaders are going to benefit from the latest stimulus package.
Right, Fan Cheuk, Asia CIO at HSBC Global Private Banking and Wealth. Thanks so much for joining us. Let's take a look at how stocks are moving in Asian markets in the early going. No surprises here. Look at some of those big chip makers and those big electronics names. Samsung Electronics off by 2.4%, SK Hynix by 4%. Renesas in Tokyo is off by about 4.5%. We don't have any trading yet for Tokyo Electron, but none of this particularly surprising. We had a bunch of somewhat poor tech news out of the US. We've got Biden administration officials discussing capping the sales of advanced AI chips from NVIDIA on a country-specific basis. We had some very weak numbers out of the Dutch chipmaker ASML, booking only about half the orders that analysts were expecting there. Qualcomm also announcing that it's now going to wait until after the US election to decide on its move on Intel also. So some of those big chip names showing a fair bit of weakness in Asia at the moment, and the broader indexes lower as well. More ahead on the Asia trade. This is Bloomberg.
Hong Kong Chief Executive John Lee is set to deliver his yearly policy address today, with the financial hub's struggling economy as a key focus. Chief North Asia correspondent Stephen Engle joins us now from outside the Hong Kong government headquarters. And Steve, what are the expectations that are being set here?
Well, it has to be about the economy and stimulating this global international financial hub because it struggled, obviously. Tourist numbers are down. Retail sales are down in August, sixth straight month, down double digits, down more than 10%. So shops and shop owners are suffering. People's wages are suffering. The financial sector has been hit with job cuts as deal flows have dried up. IPOs have dried up. Yes, things have gotten better. A number of IPOs have increased. The stock market has jumped a bit on that Chinese stimulus, also on speculation of further Fed rate cuts. That could alleviate some of the pressures here, obviously in Hong Kong. But again, the Hong Kong stock market, keep in mind, is still one of the worst major global performers since the end of 2020, even with the more recent rally. So there are lots of long-term goals that John Lee, the chief executive, will spell out. But also, I think a lot of people are looking for those short-term stimulus measures. But those long-term ones is going to obviously be closer integration with mainland China. They have an augmented CEPA agreement, which is a free trade agreement, the closer economic partnership agreement with mainland China. They're going to implement more of that. They're going to talk about the northern metropolis, more integration between Shenzhen across the border with mainland China and here in Hong Kong. They also want to diversify the economy beyond the core competencies of financial services, of property. That's a whole nother subject that we can talk about. And of course, some of the other integration with mainland China. Short term, we need help on the retail front and boosting consumption. As I talked about, those retail sales have been down.
Steve, it doesn't end there. Let's talk about tourism. And I'm just reading off the Australian Department of Foreign Affairs website. Australia's got a travel warning in place against Hong Kong at the moment, warning you could be detained without charge and denied access to a lawyer. So tourism's dried up for overseas arrivals. Are we going to hear any specific measures to do something about this?
The Hong Kong government has spent a lot of money to try and do promotions to get people here. They've done free airplane ticket giveaways. They have drone and pyrotechnic shows at night. One of the speculations is that John Lee will announce a cut in liquor taxes to kind of boost the so-called nighttime economy here. Nightlife used to be really bustling. If you go down to Lang Kwai Fong in Central District now, it's a pretty quiet place compared to the heyday. So again, that could be one measure that John Lee does to try try and stimulate the attraction of Hong Kong to foreigners, but the numbers are not pretty. 2018, before the pandemic, Hong Kong saw a record in 2018, just 6 years ago, of 65 million tourist arrivals. In 2023, post-pandemic, while the rest of the world has really returned to pre-pandemic levels as far as tourism, especially Japan with the weak yen, but also Thailand, South Korea, and elsewhere, Hong Kong had little more than half that record high last year in 2023 of 34 million tourist arrivals. So far in the first 8 months of this year, it's a little bit better, trending a little bit better, 23 million, but 22 million of those are essentially from mainland China. They are not getting Europeans, they're not getting Americans. One of the big reasons is the flight or the seat capacities, the seat numbers to North America and from North America to Europe and back from Europe are down double digits, 30% in the United States to and from the United States, 40% to and from Europe. So there's a lot of room to go.
Our Chief North Asia correspondent Stephen Engle there in Hong Kong. Staying with politics, Republican presidential nominee Donald Trump has told Bloomberg that tariff is his favourite word, as he denied his protectionist policies could fuel inflation and spike the national debt. Donald Trump spoke with our editor-in-chief, John Micklethwaite, about his broader economic agenda. We are now just 3 weeks out from the election showdown with Democratic nominee Kamala Harris.
Because we're about growth. She's got no growth whatsoever, and we're all about growth. We're going to bring companies back to our country. You look at even today, as I was driving over, I see these empty, old, beautiful, like steel mills and factories that are empty and falling down. Some have been converted to senior citizens' homes, but that's not going to do the trick. And we're going to bring the companies back. We're going to lower taxes still further for companies that are going to make their product in the USA. We're going to protect those companies with strong tariffs, because I'm a believer in tariffs. I'm not sure that you are. I don't think you are, but I congratulate you on your career. But to me, the most beautiful word in the dictionary is tariff, and it's my favorite word. It needs a public relations firm to help it, but to me, it's the most beautiful word in the dictionary.
Tariffs, do you think that will bring in the revenues? To use another bipartisan group, Peterson Institute, they say they only bring in $200 billion. That is that's barely the cost of 2 of your promises.
Yeah, but that's like for what company are you talking about, okay? Look, I've brought in with tariffs, and I was just getting started. Then COVID came, and we had because I tell you what, I did a very good job in COVID. Nobody knew what the hell it was. I call it the China virus because I like being a little more accurate. But when that came, but we got hundreds of billions of dollars just from China alone, and I hadn't even started yet. But tariffs are two things, if you look at it. Number one is for protection of the companies that we have here and the new companies that will move in, because we're going to have thousands of companies coming into this country. We're going to grow it like it's never grown before, and we're going to protect them when they come in, because we're not going to have somebody undercut them.
Donald Trump speaking there with Bloomberg's editor-in-chief, John Micklethwaite. Let's take a look at how Taiwan futures are tracking. Of course, TAIEX very tech-heavy there. No surprise to see that we're expecting to see some declines today, and that would certainly be the experience that we're seeing elsewhere in terms of tech stocks in South Korea and Tokyo as well. So TAIEX futures there off by about 1.5%. Well, Bloomberg editor-in-chief emeritus Matthew Winkler sees Taiwan as a bastion of prosperity, with its stock market outperforming the world and price stability making its debt the least risky in the global market. And Matt joins us now for more on his recent opinion piece. And Matt, it's been an interesting week because we've got China conducting war games again, 153 fighter jets encircling the island earlier this week. But the market, the economy, doesn't seem to care.
Yes, and I had no trouble landing here. The reality is very different from the prevailing narrative, which is something that most people aren't appreciating, which is the stock market in Taiwan is outperforming the world. The country is experiencing record exports, a booming real estate industry. its wages are rising to the extent that you have unprecedented real income in Taiwan. And bond yields are the lowest after Japan and Switzerland, and you're talking about an inflation rate here in Taiwan that is one of the least volatile and the lowest since 2008. And just to make it even clearer, the currency is the least volatile in the world after the Singapore dollar. So all of that makes Taiwan a place of, as you said, great prosperity.
It's certainly thrived despite the external challenges, right? But Matt, I do wonder, does that sort of existential threat become greater depending on what happens in the US election?
Well, I think everybody, if you ask them this question, what is it that animates the animal spirits of Taiwan these days? And the answer is semiconductors or chips. And they happen to be the most valuable element, really, or elements in the 21st century economy. We're talking about these are the brains for smartphones, for cloud computing and transition. Just about everything that we do today is really about semiconductors. And this happens to be the place where the most advanced, most important semiconductors are made. And one important feature of this is Taiwan's biggest corporate customers happen to be outside of Taiwan, and most of them are in the US. And Taiwan is producing most of their semiconductors for these companies. You've heard of like NVIDIA, for example. And the revenue that Taiwan gets is also from the US. So this is a very important tether to the largest economy in the world. So even though we have the noise that you're talking about, the signal at this point is much more powerful than the noise.
All right. Bloomberg Editor-in-Chief Emeritus Matt Winkler there. We have more ahead on the Asia trade. This is Bloomberg. Let's get to some other stories that we're following. The Biden administration warning Israel that it must ease an increasingly dire humanitarian crisis in the Gaza Strip within 30 days. The move suggests the US may be compelled by law to cut the flow of weapons if the situation doesn't improve. The letter from the Secretaries of Defense and State is one of the most specific warnings yet from Washington to Israel. Israeli Prime Minister Benjamin Netanyahu says the country is free to act as it chooses in a counterstrike against Iran. This comes after reports that his government will heed US pleas to keep nuclear and energy facilities off its target list as Washington attempts to limit escalation. Netanyahu's office says Israel listens to US opinions but makes decisions based on its own national interest. Let's take a look at what's moving in Asia at the moment, specifically chipmakers, and Tokyo Electron now off more than 9%, seeing Samsung, SK Hynix, Renesas also taking a beating. And it was a very rough day for chip stocks in the US. ASML in Europe, meanwhile, announcing very disappointing earnings that's weighing on the sector. More to come on the Asia trade. This is Bloomberg.
We're all about growth. We're going to bring companies back to our country. To me, the most beautiful word in the dictionary is tariff, and it's my favorite word. It needs a public relations firm. I had a very good relationship with President Xi, and a very good relationship with Putin, and a very good relationship with Kim Jong-un.
You worry about that?
The dollar is so secure, your reserve currency is the strongest it'll ever be. I think that if you're a very good president with good sense, you should be able to at least talk to him. I don't say make the decision at all. Take a look at Detroit. Take a look at our cities. We're a developing nation. We have to develop more than they do.
President Donald Trump there speaking with Bloomberg's John Micklethwaite about his economic agenda. And we are here, of course, just 3 weeks out from Election Day. I want to bring our next guest, who previously served on the Democratic staff in the US Congress and as Chief of Staff to the Australian Prime Minister, Julia Gillard, as well. With us now is Bruce Wolpe, who's the Senior Fellow at the US Studies Centre. He is also the author of a book entitled Trump's Australia. Impeccable timing for you to join us today, and of course on the back of that conversation with the former president. How do you assess the state of the race right now?
The state of the race is tied. It's been frozen. What's really interesting is it's been like this with Biden. It's been like this with Trump and Harris running parallel with each other within 1 or 2 points. And the same, but a national poll does not decide the election. It is with the states in the Electoral College. There are 7 swing states, and all the polls in all of those states have them also within 1 or 2 points with each other. We haven't seen anything this close in a really long time.
As an advisor, what does each side need to do in this final leg?
Harris has to come out more strongly and tell the country where she wants to take it, what her policies are, instead of just presenting as the new candidate of change, but to go deeper, to reach the aspirations of the American people and show how she will bring the country together and turn the page on the past. I think she's in the process of doing that. She also has to rebuild the voter coalition that Biden had assembled to win in 2020. In other words, more young people, more women, more people of color, and have them return to her so that she can beat Trump. She's in the process of doing it. Whether she gets there, that's the big question in this campaign.
I understand voting has already started in Georgia. How important is turnout going to be in this campaign, and where do you expect turnout to land in a country where it's traditionally quite low?
This is a really interesting development today in Georgia. On the first day of early voting 4 years ago, 130,000 people turned out. To over 250,000 people voted today. And there were very heavy statistics in black precincts in Atlanta. And so this is really good news. It's a straw in the wind, good early news for Harris. And Georgia is so important. If she can carry Pennsylvania and Georgia, she will win the election.
Talk a little bit about policy and specifically some of the words that President Trump was talking about earlier, saying, for example, tariff is his favourite word. I mean, on the surface, this is probably very appealing to a lot of voters, but are there some unintended consequences here? Could the very people that vote for this end up wearing the costs that end up filtering down to consumers?
Trump uses tariffs as sort of his holy grail to solve economic problems. His base buys it. The 45% of Americans that are with him, they've been with him for 8 years in this journey. No one has defected, even after Biden stepped down and Harris stepped up. And they buy his message. But I think it will have, every reputable economist says it's going to have deleterious effects on the American economy, raise prices, and drive away jobs. But for the moment, he's wielding this like a sword against the weakness of Biden and Harris on the economy. Inflation, interest rates that are just receding, but people don't feel as secure as they did when Trump was president and the economy was better for a lot of people.
You're obviously, as we alluded to earlier, written a book about Trump's Australia and what his policy measures mean for particularly open and vulnerable economies like Australia. I do wonder, is there any advantage gained in the fact that, you know, he is more of a known entity in terms of what we know for consistency in his policies?
I think looking back on the first term, there was an excellent relationship that Australia ultimately forged with Trump. Of all the countries in the world, I think this country had the least troubled relationship overall. Think about his attitude towards Europe, Merkel in Germany, Theresa May in the United Kingdom. He got along fine with Australia's prime ministers. There's also a free trade agreement between...
In many ways come at the expense of the relationship with China, though.
Well, yes, and the big question for the future going forward, Trump and Australia, is China. What does he really want with China? Is it a trade relationship, a trading agreement, a new one, that's going to serve the interests of the United States? Is Taiwan part of that bargaining? And that is the great uncertainty. But as far as the bilateral ties, they're pretty strong. Just one other point on trade. The United States has a trade surplus with Australia. That means Australia's off the table for retaliation as he wants to go after other countries that he sees takes advantage of the United States.
If it is a Harris administration, is it just sort of consistency from the handover?
I think what we'll see with Harris is a continuation of the Biden policies. That's from AUKUS to the Quad and all the arrangements throughout the Indo-Pacific region. She's been with him lockstep on that. There's no reason for them to change the posture. I think it's a winning posture in terms of the array of aligned countries engaging with China. It serves U.S. interests and outlook. So I see a continuation of the status quo in Asia as far as Australia and Harris are concerned.
I was reading some of the excerpts from your book and also some of the reviews of the book saying that, this idea of the catastrophe element of a Trump administration and the danger of the return that you've written about. Are you feeling calmer about prospects this time?
No, I'm feeling more worried.
Because he's got JD?
Trump is going to alter America's democracy. And some of that change comes across to countries like Australia every morning in the news. You start talking about your enemies. You start abusing power, using the institutions of government to get your agenda. If America drifts from democracy, and what is the basis then of the bilateral ties, the alliance between Australia and the United States? We're together because we believe in democracy, liberty, freedom of speech, freedom of religion, the same values. If the United States is not upholding those values, why have such a strong alliance with the U.S.? I think that's an existential question. I hope we never get there, but I think it's a possibility because Trump, when he comes back, he's going to act on vengeance and retribution against those who punished him and those he feels are his enemies. It's a really tough future.
Bruce, do you feel the AUKUS alliance remains safe and this exchange of nuclear submarine technology continues under a potential Trump presidency?
What I think is going to happen is I think Trump will look on AUKUS as a business deal. I think he wants it scrubbed, and he says, oh, this is a really big project. Where's the money going? Where's the contracts going? Where are the jobs going? Does this serve America first? Now, I think he'll come out on the other side as seeing it as an okay agreement. And I can see a replication of what he did with the U.S.-Canada free trade, U.S.-Canada-Mexico free trade agreement, which was say, this agreement is terrible for the United States. It's got to be rewritten. He did that. He made almost no changes, but he put his name on it. And I think the same is going to happen with AUKUS. I think that's the most likely outcome.
Is foreign policy going to differ in terms of how the next administration deals with now a multitude of conflicts on different fronts?
Yes. Trump wants to retreat from engagement around the world, and particularly military engagement. I think it's pretty clear from his discussions on Ukraine that he's going to call up Putin and say that time to end this war, guess what, you win. And Putin is able to keep a sizable chunk of Ukraine that he went to war over. In the Middle East, I think his message to Netanyahu is end this war, finish it, because we've had enough. I think he'll be aligned with the Saudis as far as Iran is concerned. But I think the overall, what the message is knock it off, stop the violence, and it's okay if we reward some people that we've had troubles with in the past, Putin, Xi, others, and let's live a more peaceful existence.
Bruce, really great to have you with us. Bruce Wolpe is a senior fellow at the U.S. Studies Center. We do have much more on the election race, of course. If you take a look at Bloomberg's Big Take from today, it takes a look at our dozens of lawsuits now playing into the campaign. Subscribers can read that story in full on the terminal and also on the website, of course, on Bloomberg.com. A quick check of how we're faring when it comes to the Australian trading session. And of course, we are seeing equity markets off those record highs. We're seeing some of that weighing down by iron ore miners in particular. Looking ahead to, of course, that briefing from the Housing Ministry in China on Thursday, whether more stimulus measures or loosening of restrictions could be expected. But certainly some of that weakness coming through now. That tech sell-off more broadly is running through the rest of the Asian session. Australia's Reserve Bank says it is still running through the local implications of that China stimulus package and what's sort of been announced already to date. The Assistant Governor, Sarah Hunter, told us earlier that they're looking at the whole economic picture ahead of an update of forecasts that we are expecting next month.
Government spending, as it's obviously one part of total spending through the economy, and it's an important part. So we take those government spending decisions, budget decisions, as given. So we did a sort of fairly big update after the May S&P and going into August, because that's when we got the federal budget and a number of the state budgets as well. We take those as given. We feed them in, but for us, really, it's the aggregate picture, what's happening across the economy, that really matters. So we're considering what's happening in the public sector, but also what's happening across the private sector. That's not just households, though they are and a very important part, biggest part of demand, also businesses, what's happening with residential construction and with trade. So we're taking the whole picture together and looking at what that means for the labour market and for inflationary pressures. So it's how the whole thing comes together is really the focus for us.
Does the China stimulus story, the potential rebound path, change that aggregate at all? Like, what do you factor in with your calculus there?
Yeah, absolutely. And it's obviously very recent news. It's certainly news that we've had since August, so we are factoring it into our forecast going into November. And we do pay, as you might expect, a lot of attention to China, given how important it is to the economy here. So we'll be looking at that and what we think that might mean in terms of growth, not just for this year, because obviously most of this year is now done, but really what it means for 2025. So we're working that through at the moment, but it's still very new news for everybody, so we haven't got our definitive forecast locked in just yet.
Do you think during the period of China weakness, the Australian economy has, in a way, sort of, necessarily not decoupled, but certainly diversified from that reliance? Or is this still a pretty big chunk of what happens?
It's an interesting question, because it really, there's two parts to it. There's what happens to demand in China, obviously that's determined over there, but also how producers here respond, businesses here respond, so particularly in the mining sector, but also what we might see in terms of tourism flows, international student flows and that sort of thing. We have seen that there has been strong growth in other markets. So that's not necessarily a China story. That's more what's happening there, and that's come through particularly on the student side and a little bit on the tourism side as well. But having said all of that, China is still by far and away Australia's largest export partner. We still have very strong linkages there, and China matters obviously for the global economy more broadly, and that matters for global economic conditions, and as a small open economy that generally matters for us. So China's still very important, and we still put a lot of our time and attention into thinking through what's happening there and what it means for the economy here.
Assistant Governor at the Reserve Bank of Australia, Sarah Hunter, there speaking to us a little bit earlier here at the Citi Australia and New Zealand conference. We have more ahead on the Asia trade. This is Bloomberg.
Donald Trump is defending his economic agenda against big business fears over inflation. Trump told Bloomberg editor-in-chief John Micklethwaite that his economic policies would inspire growth despite adding to debt.
I had 4 years no inflation. But
that was when you had much.
I had 4 years. It's better than that. And Biden, who has no idea where the hell he is, okay? Biden went 2 years with no inflation because he inherited from me. And then they started spending money like drunken sailors. They spent so much money. It was so ridiculous, the money they were spending. They were spending on the Green New Scam. The Green New Deal. It was conceived of by AOC +3. She never even studied the environment in college. She went to a nice college. She came out, she just said, the Green New Scam. She just named all these things.
But President Trump, the issue at the moment, the markets are looking at the fact you are making all these promises. Latest one was car loans. You're flooding the thing with giving giveaways.
But we're going to grow.
I was actually quite kind to you. I used 7 trillion. The upper estimate is 15 trillion. People like the Wall Street Journal, who's hardly a communist organization,
yeah, but you don't know.
They have criticized you on this as well. You are running up enormous debt.
What does the Wall Street Journal know? I'm meeting with them tomorrow. What does the Wall Street Journal know? They've been wrong about everything. So have you, by the way. You've been wrong about
You're trying to turn this. You're trying to turn this.
You've been wrong about
You're trying to turn this into debate. There are business people. There are business
you're wrong.
people.
You've been wrong all your life on this stuff. You've been wrong. Let me tell you about currency. You're going jump in a lot of different subjects.
Whilst you're sticking to the subject very closely.
Let's stick to reserve currency. That's where you start, right? The reserve currency is under threat. because you have Iran, you have Russia, you have China. China's the one that you have to worry about because they want it.
Yeah.
They want to have the yuan be the thing of power. So here's what I'm doing. Again, I hate to go back to it. If somebody says, and I know countries want to get out because they don't respect our leadership, they look at this guy, they say, you got to be kidding, and she's worse than him. By the way, I never thought I'd say this. She is not as smart as Biden, if you can believe. This is not what, we had 4 years of this lunacy, and we can't have it anymore. We're not going to have a country left. Okay, currency, very important.
Yes.
And if you want to go to third world status, lose your reserve currency. We have to have that. We cannot lose it. If you'll go to third world status in this country because you take a look at the way things are running. If a country tells me, sir, we like you very much, but we're going to no longer adhere to being in the reserve currency. We're not going to salute the dollar anymore. I'll say that's okay. And you're going to pay a 100% tariff on everything you sell into the United States. And we love your product. I hope you sell a lot of it into the United States, but you're going to pay 100% tariff. He will then follow it up by saying, sir, it would be an honor to stay with the reserve currency. That will be like just playing. That's not even chess, that's checkers.
Donald Trump speaking with Bloomberg's John Micklethwaite at the Economic Club of Chicago. Some corporate earnings that we're tracking. Citigroup among some of the big US banks that reported on Tuesday, alongside Goldman Sachs and Bank of America. All three lenders posted equities and fixed income trading hauls that beat estimates for the quarter. Citigroup CEO Jane Fraser acknowledged the bank's performance is still a work in progress, but says global economic performance continues to be surprisingly resilient. US-listed shares of LVMH slumped after the luxury goods giant missed estimates in its latest results. Sales fell for the first time since the COVID-19 pandemic, hampered by slumping Chinese demand. Morgan Stanley says declines in third quarter organic sales for the LVMH fashion and leather goods unit came in well below expectations. Talking of things that are falling below expectations, Asian chipmakers having a wretched morning at the moment. Look at Tokyo Electron, now off by 9.5%. Nikon, Fanuc, they have something in common. They have a few things in common. Not only are they going backwards today, they are both major suppliers to ASML. And of course, it was the Dutch chipmaker that inspired a lot of the selling that we saw both here in Asia today and in the US. Very disappointing earnings. Concerns about tighter restrictions on chip sales as well, and ASML only booking half the orders that analysts expected. That stock was down 16% in Europe, the most in 26 years. Samsung Electronics also feeling the pain, off by 2.1%. Well, let's get a bit more on those ASML figures. Bring in our tech reporter, Annabelle Drewlers. Annabelle, big miss, worse than analysts were expecting.
Yeah, actually quite significantly worse than what analysts were expecting. I mean, you just said there about half of the orders in the third quarter that were booked, and we also got that 2025 guidance, and that wasn't great either. And it's that real concern that we're seeing in the chip industry. Yes, you've got ASML that is obviously providing the most advanced machinery or tools for making high-tech chips, but at the same time the recovery in the chip industry is sort of two-speed, because you've got that big focus on AI chips. At the same time, you're sort of seeing a lot of that slump persisting for ones that are more legacy chips, so ones that are used for automotives or consumer electronics, and that's sort of the concern that fed through in these results from ASML. And again, as you said, that share price reaction, I mean, the biggest drop, as you said, going all the way back to 1998. And taking a look at some of the suppliers here in Asia today, I mean, this is really broad-based now, the selling pressure, as you said, in Wall Street. But today, chip stocks or tech-link stocks are the big laggards in the session so far.
We've also heard a bit more about Qualcomm's possible takeover bid for Intel.
Yeah, that's right. So this was another story that came out in the last few hours or so, and it's sort of this big question mark over whether Qualcomm would proceed with a proposed bid to take over Intel, and of course when that would happen. The sources that we're speaking to are telling us something around the possibility of when this would happen, and the fact that it could possibly be pushed out to post the US election, post the inauguration as well in January. Now, the reason for that is sort of twofold. Firstly, you've got that question marks over the antitrust landscape. Where do we go from here? It's also the question of whether President Trump back in the White House or President Harris, what does that really mean for the relationship between the US and also China? And as we said, that possible delay coming through. We've also heard, of course, that Qualcomm has approached antitrust officials in Beijing, waiting for any sort of guidelines around that. But yes, earnings, of course, the other big factor they could push out to after the earnings release, given Intel will be reporting its numbers at the end of this month, and they are expected to be pretty grim, tracking what we had for the second quarter as well.
Cheuk reporter Annabelle Jewellers there. We do have much more to come when it comes to what we're watching in chips. Tomorrow's show, we'll be speaking exclusively to AMD's Chief Technology Officer, Mark Papermaster, about their new AI products and the outlook for the broader sector in Asia. This is Bloomberg.
Some corporate stories that we're tracking. Data center developer DataBank has raised $2 billion to build 3 facilities across the US, and the latest sign of superheated investor interest in AI. Pension fund Australian Super led the raise with $1.5 billion. It will become a minority owner of DataBank and appoint a director to the company's board. Boeing shares advanced after the plane maker took a step towards raising up to $25 billion in bonds or share sales to help withstand a prolonged strike. It's also secured a $10 billion credit agreement with US banks. The added firepower could help Boeing improve its bargaining position with striking workers who are seeking higher wages and a reinstatement of pensions. Shein is said to be adding more banks to help arrange its potential listing in London. Sources say Barclays and UBS have been picked as bookrunners for the online fashion retailer's IPO. And we're told that listing could happen as soon as early next year, valuing the company at about $65 billion. Haidi.
Taking a look at how we're tracking when it comes to the session for Taiwan futures in particular, given that we've seen that mega sell-off across the chip sector. We've seen stocks more broadly halting the rally. Nvidia, ASML just getting crushed, and that is expected to pass through to the tech-heavy TAIEX. That is it for the Asia trade. Our markets coverage continues.